Good afternoon, everyone. Gary Voigt. I'm with the Baltimore Life Companies. I want to thank Premier Marketing, who has been a fantastic partner with us through the years, especially with the products we're going to be talking about today, and that's our tax-efficient asset transfer program. If you're new to Premier and it's the first time you're hearing about these products, I think you're going to really enjoy what you're hearing today. If you've been with Premier for some period of time and you've heard about these products before, I think we have a new wrinkle or two that we can be talking to you about as well. So we're looking forward to getting you started on a fantastic start to your 2019. So two products we'll be focused on today are Generation Legacy and our single premium whole life product. Both of these products are really designed with your senior client in mind, who have what we like to call some leave behind money, money they don't need to live on. They simply want to leave that money behind to the next generation. No matter whether you've got funds coming from a, after cash tax funds like CDs, money markets, mutual funds, or you have funds coming from annuities or non-qualified or qualified plans like 401ks and IRAs, we have a product solution for you. So sit tight and we'll be talking through all this today. Let's talk a little bit about the marketplace to get an appreciation for that. There's roughly about $1 to $3 trillion in wealth that's being transferred each and every year, and that's continuing to happen between now and the year 2052. We know that about 55% of your clients' wealth is being passed along to their family members, and about 16% of their wealth is moving on to their favorite charities. So yes, about 71% of your clients' wealth is being passed along to people and organizations they know and love. The question is, are they maximizing the amount of money they're able to pass along, and are they really doing it in the most tax-efficient way? Well, the first product we'll talk about today is our Generation Legacy product, and this product is really designed to help you facilitate the transfer of single premium dollars from either non-qualified deferred annuities and other qualified plan funds that aren't needed for daily living. Qualified funds such as 401ks, IRAs, 403bs, and the like. We were talking about the fact earlier and before this call started that, non-qualified, especially fixed deferred annuities, sales are really been soaring the last 2 quarters. But, they're great products. They're fantastic for growth and grow on a tax-deferred basis. But the question is, are people really needing that money for income down the road? And are they just looking to pass this along to the next generation? And we'll talk more about those opportunities. This is a great way to leave an estate for your clients' heirs or favorite charities, and it does, in fact, with a single premium, allow them to instantly increase the estate value they're able to pass along. The issue age for this product is 60 to 80, and our Generation Legacy product is very unique. It allows you to write a single application, and with writing that app, we're going to issue 2 products. Our single premium immediate annuity, which will receive the transfer of those single premium funds, along with a limited premium payment whole life product. Once issued, Baltimore Life will seamlessly administer these 2 products together to provide you all the benefits we'll be talking about here today. We have simplified underwriting on this product through 4 tables of underwriting, so a nice blended rate for the simplified underwriting approach, and we'll talk about our point of sale underwriting as well that complements it. We also have an accelerated death benefit rider, which is automatically included in all states where the rider is approved, and that's the high majority of those states, which really do, in fact, provide your client with living benefits at a time when that money could be needed most. A new wrinkle to our Generation Legacy product for those of you that might be familiar with it, but might not be familiar with this option that we put in last year, and that's our spouse option. Do you get into situations, I'm sure you do, with a married couple, and you have one spouse who's healthy and insurable with life insurance, and maybe you have another spouse who is not healthy and really insurable through 4 tables, but they have significant assets that they need to distribute through annuities or qualified funds. They know that their lifespan is going to be shorter, and they're just trying to find ways to accelerate the distribution of those funds. Well, we can set up a Generation Legacy product using the spouse option where you have a primary insured, which again is the healthy spouse, and the annuitant would be the person that would be unhealthy that we would receive the transfer of funds from their annuities or qualified plans. The annuity from that unhealthy spouse would fund the life insurance for the healthy spouse. Now, the key thing is when this is set up, of course, the intent is that we want to have this life insurance product over here that's providing income tax-free death benefits to the family members, even if the annuitant, the unhealthy spouse, dies early. So as a result, the annuitant will waive the right for the beneficiary, which was the healthy spouse, to commute future SPIA payouts in a lump sum upon the annuitant's death. We need to make sure that those annuity payments continue to pay for the life insurance over the span of 7 or 10 years, depending on the issue age, and we'll talk about that in a moment. So that's a great opportunity for you when you run into those situations. So what about the annuity and qualified market? You know, it's about $2.7 trillion of in-force deferred annuities out there. We know that about 65% are tied up in tax-qualified employer plans. About 35% are truly in those non-qualified deferred annuities that you're selling. As I mentioned earlier, you know that a significant share of this money, the annuitant has no plans of ever taking a distribution of the funds. They simply want it to accumulate and thus transfer it to the next generation. The key thing to remember is that if you have, you know, a qualified plan out there, there is going to be a required minimum distribution at age 70.5. So there's going to have to be some level of distribution of those funds. And of course, when the annuitant dies, the tax on the gain on that money is just simply going to be passed along to the survivor, who's probably in a higher tax bracket. So there's no disagreement by anyone that annuities are fantastic products, but really, are they the best product to die with? And we feel that Generation Legacy provides a great option. Here's a conceptual look at Generation Legacy. I want you to think of it as a gift your client's going to pass along to the next generation. And inside this gift box, you're going to help facilitate the transfer of funds from annuities or qualified plans again. With a single app, as I mentioned, we're going to issue 2 products, the SPIA, as well as a limited premium payment whole life product. Now, over a period of either 7 or 10 years, the money that was put in that SPIA, that was the receiver of those funds, Baltimore Life will make annual automatic premium payments from that SPIA to pay premiums on the life product over the 7 to 10 year period. So what dictates the payment pattern? It's the issue age. The client 60 to 74 will issue a 10-year payout on the SPIA, along with the 10-year paid-up life product. For 75 to 80-year-olds, a 7-year payout on the SPIA, along with a 7-year paid-up life product. But here's where the benefits really can get rich if death were to occur early. We know that the life insurance product will always be there, if left in force, to pay a income tax-free death benefit that's greater than the single premium. That's true of any single premium product. But with this product, because we have that funding vehicle, the SPIA, around, that's funding the life product over a 7 or 10 year period, if the client were to die early during that 7 to 10 year period, any remaining payments that were left in the SPIA, not used to fund the life insurance, would also be paid to the named beneficiary. So they're not only getting the life insurance paid out, but also the remaining payments from the SPIA. That's a lot of bonus in terms of features for this product that clients absolutely love when they see it. So after a period of 7 or 10 years, the life product, of course, becomes paid up. It continues to provide a death benefit that's greater than the single premium paid. It continues to provide cash value growth on a tax-deferred basis, and yes, continues to provide the accelerated death benefits that we'll be talking about in more detail. So just as a wrap-up, the issue ages are 60 through 80. We do base our pricing on current age or age at last birthday. Now, this is important because you're dealing with a product that's going to, you're going to have to facilitate the transfer of funds from other products and institutions. That transfer process will take somewhere between 20 to 35 days. And we will issue the policy based on your client's age the day we receive the funds. Now, the minimum premium to get this started is only $5,000. How many people do you know out there that have annuities in multiple denominations, multiple annuities, that again, if you just simply ask, you'll find out their only goal is to pass that money along to the next generation. The average premium, by the way, we see on this product is about $60,000 to $65,000. The maximum face amount that we'll issue based on the single premium paid on the life product is $450,000. Now, we do have 2 underwriting classes. We have either non-tobacco or tobacco. And within that underwriting class, again, we'll issue any risk standard through Table 4. Cash values, they accumulate in the life insurance product on a non-participating basis. Key thing here to remember is liquidity, partial surrenders. You can take partial surrenders from the life insurance policy cash value, but they're permitted after the life policy becomes fully paid up. That's 7 or 10 years. Loans, they're available at any time from the life policy's cash value at a maximum interest rate of 8%. So now let's talk about that accelerated death benefit rider, which, as I agree, you can say these truly provide living benefits to your client at a time when it's needed most. And, this is not a substitution for a good long-term care policy, but, most seniors have a very difficult time affording good long-term care insurance. So isn't it nice to know that they can accelerate their life insurance benefits at a time when money really could be needed? There are 3 health event triggers, as I call them, to accelerate the benefits on the life product. They are terminal illness, confinement to a qualified nursing home facility, and in situations of extended care, home health care, and adult daycare. This does increase, obviously, the liquidity of the life product. And upon the decision to accelerate, which can happen anytime after issue, a lien against the policy's death benefit will accumulate prior to death at an annual interest rate of 8%. We'll show you that calculation method in just a moment. The maximum acceleration is $250,000. The minimum is $5,000. But here's the great news. This benefit is paid out once. It's paid out in a lump sum, and these benefits are unrestricted funds. So the client can use these funds for whatever reason they deem necessary. If they want to take a trip around the world or use them for healthcare benefits, whatever they'd like to use them for, it's up to them. So now let's get into the details of these riders, what they cover, and the percentages of potential payout. First is terminal illness. In this case, client would need to be diagnosed from their physician as terminally ill with a life expectancy of 12 months or less. In this case, they can accelerate a maximum of 75% of the death benefit. The second rider covers both nursing home facility confinement and extended care. In both cases, the maximum accelerated benefit amount is 50%. For the nursing home confinement, they need to be diagnosed as chronically ill and confined to a nursing home continuously for 90 days with the expectation of a permanent confinement. For extended care, again, chronic illness, have been so for 90 days, but now they're requiring care provided by either a licensed home health care agency or a licensed or state certified adult daycare center. Again, in both situations, the maximum accelerated rate is 50%. Now, there are about 6 or 7 states out there that have slightly different provisions on the percentages of payout. For example, Pennsylvania and Indiana have a 65-40 payout rate instead of 75-50. The riders are designed to be able to provide cash now, but still have remaining life insurance benefits in all cases. So what is the definition of chronic illness? If the client satisfies either of these definitions, we consider them to be chronically ill. They can be unable to perform either 2 out of 6 activities of their daily living, as you see on the screen, or if they're okay on their ADLs, they could be suffering simply from a severe organic mental illness, such as Alzheimer's or dementia. In either case, we consider them to be chronically ill. So let's look at some examples of payouts here. The first example is assuming the client has a face amount of $100,000 on the life product and they're terminally ill. If they accelerate that benefit, they could get a cash payout as a living benefit of $75,000. We do charge a one-time service fee of $100 for that transaction. So if this client were to die immediately after getting that cash payment, no time for interest to accrue on the lien, the death benefit would be the face amount less the $75,100, giving you a remaining life insurance benefit of $24,900. But here's the more likely scenario. This is where the client lives about 1 year after getting that cash payment of $75,000. So now 1 year later, the death benefit is the face amount less the lien, the original lien, plus 1 year's worth of interest, giving you remaining life insurance benefit of $18,892. So in this example, this client would have to live 4+ years for the interest to outrun the remaining life insurance benefit. Extremely unlikely that's going to happen in a terminal illness situation. And that's why when you get to nursing home and extended care situations, that maximum benefit goes down to 50% because simply the client's going to live longer. So you still always want to keep this set up as a life contract and still providing some remaining death benefit. So could these riders technically terminate from the life policy where they're attached? Well, technically they could. Because these are two different contracts being hooked together and administered as one, the client does still have the right if they say, you know what, 2 years ago I gave you $100,000. I didn't think I needed the money. I just wanted to pass it along. But now in the third year, I've got some needs that are pretty significant. They could cash the life policy out where the riders would go away, and then the remaining payments from the SPIA would be paid to them, at that time. So in that case, they would lose the riders. If death occurs, we don't pay a rider benefit, we would pay a death benefit. And finally, if you accelerate under one of the rider benefits like nursing home at 50%, you can't come back later and accelerate for an extra 25% for the client being terminal. Or you couldn't, let's say if the client's terminal, accelerate at 35%, and then later come back and get another 40%. You accelerate it once, then basically you can't accelerate another time. The death benefit would be paid out later, based on the calculations I showed you. Keep in mind that if the lien ever exceeds the entire remaining death benefit, the policy technically could terminate. Very, very unlikely, though, that would be an event to happen. The owner, if that does potentially happen, has the right to repay all or part of the lien at any time to keep this qualified as a life contract. Keep in mind that even though you accelerate, there's still a cash value that accumulates in the life policy, accumulating on a tax-deferred basis. If you have a policy loan that's active at the time that you're trying to accelerate, you can't accelerate. You either have to have a loan or a lien through the accelerated death benefit rider. You can't have both. And finally, the last thing, no matter who you're working with, any company that has a similar type rider, you should always tell your clients to consult with their tax advisor. So let's look at a quick example of a potential payout here. This is a female 70 non-tobacco user, let's say has 50 grand sitting in an annuity. She decides to set this contract up with a life product that has a death benefit of $78,000, nearly $451. So at issue, she's increased her estate value by $28,000, nearly $451. Keeping in mind that if she dies in the first 10 years, the remaining payments from the SPIA would also be paid. But as we were talking about the accelerated death benefits, look at these cash payments that she could receive if she qualified under one of the health event triggers. These are the maximum benefits, and truly this is real cash to a senior at end of life to help for whatever reason they need the funds. So a very, very powerful rider to sell and for the client to have in case that event were to come up. So what's another tax efficiency of this program? We feel it has to do with the distribution of the funds from the annuity or the qualified plan. You know that, if you have an IRA, then money's never been taxed before. If you have an annuity, there's a basis and a gain, and eventually Uncle Sam is going to have to be paid tax on those funds. So the beauty of this is, let's say you're rolling the money from an IRA, that money is rolled into a SPIA product that's going to be funding life insurance. So as a result, we're able to spread the tax out on the gain for your client over that 10 or 7-year period, depending on what the issue age is and the payout period. So your client will in fact get a 1099 each year for the distribution that was taxable, that portion of the money that the origin it came from, the IRA or the annuity, that portion of which is taxable. But the beauty is they're able to spread that money out. The other nice thing is that the SPIA payment that we make each year to pay the life insurance does satisfy the RMD rules. So there's no worry about calculating that for RMD. And the last thing to remember is that with life insurance, we know the life insurance payout at death is income tax free, but the remaining payments from the SPIA, we default those payments on an annual basis. So just like they would have been paid to the life product, to the beneficiary, that we get the remaining years of payments on an annual basis. They can, though, say, you know what, I want a lesser commuted lump sum, and we would pay the lesser commuted lump sum. In either case, annual payments or lesser commuted lump sum, they will get a 1099 based on the taxable portion of those SPIA payments, the money that had not been taxed before. So let's take a look. Oh, one more thing here I forgot on tax is the application. Because we're dealing with the transfer of funds from qualified plans, we have to ask the question on the application, do you want a withholding from the money that you're rolling over? We have to ask that question, but the product has been designed that we cannot accommodate a withholding on the money we're transferring. We need all those funds to make this thing work. So please make sure you check on the app the box that says you do not want tax withheld from the annuity that you're rolling over. Otherwise, we have to send everything back to you. So now let's look at some premiums to death benefits. And I want you to be thinking about those clients that you have out there that have annuities, have qualified plans, and God knows, you know, the people that are in the boomer market out there now are in a situation that have money tied up in 401ks that they're going to need help with the distribution of those funds. Some of those funds may be used as income, some of the funds may be used as a legacy builder, and this is a perfect solution for them, or again, those annuity clients who have no plans of ever annuitizing the funds. Here's the 65-year-old with 50 grand, let's say, from an annuity, and because they're 65, we're going to issue a 10-year payout on the SPIA along with the 10-year life product. Again, with one application you're going to write with us. The male's face amount would be $77,361 and change, and for the female, the face amount is $87,031. So what did you just do for this female client that you set up? You basically increased her estate by over $37,000 at issue, keeping in mind that if she dies in the first 10 years, the remaining payments from the SPIA would also be paid. She may say to you, well, you know, Kathy, what if I had an annuity that I'm in a 25% marginal income tax rate and I'm making 3% on the money? Wouldn't I be better off staying with the annuity? It would take her over 19 years just to accumulate the $87,000+ that is going to come from the life insurance. So, you know, you can see the power of setting this up provides you with a very nice lump sum life insurance benefit that would be paid income tax free to the beneficiary. Here's the 75-year-old, little older, shorter life expectancy. The numbers still look good, don't they? For the male, the face amount, that same 50 grand is going to be $61,516 and change. And for the female, the face is over $67,000. Now, keep in mind, because the client's 75, we're going to issue a 7-year payout on the SPIA along with a 7-year paid-up life product. All right, so I'd like to show you another visual here that's a ledger. It's a screenshot, actually, of a ledger that's part of our proposal software. Both the Generation Legacy we're talking about now and our single premium whole life product that we're talking about next are non-illustrated products, meaning a signed illustration is not required. You can use a proposal that we have out there if you'd like, and that's, you know, optional. That gives a description of the product and some nice ledger information you see here. Or you can use our mobile link software that I'll talk a little bit about later. But here you can see the client 70, non-tobacco, who has 50 grand coming from an annuity. Her basis was 40 grand. You can see in column 3 that 50,000 going in as a single premium. Out of that premium, $5,570 a year will come from the SPIA each year to pay the premium on the life product. Out of that total premium, nearly $4,000 of it is excluded from tax, and the estimated taxable income based on the interest factor over 10 years is about $1,571. That's the amount your client will get a 1099 on. So it's so very important that they make sure they understand and make sure the client understands with no surprise that they're going to get that 1099. But the beauty is they're able to spread that income out over that 10-year period. The ledger goes on to show the death benefit at $78,451 and the commuted lump sum of the SPIA at death if the client were to die early. So it gives you a nice understanding of the ebb and flow of how the product works from a value standpoint. My advice to you is that out on our agent website, we have point of sale presentation software, conceptual presentation software. It's very important that you not only do a good fact find to find the money, but also conceptually have the client understand the concept of asset transfer before you get into these proposals. Too often we see agents that are trying to sell right from an illustration or proposal with numbers, and the client doesn't 100% understand the concept of what you're trying to achieve, and you really maybe haven't done as much on the fact find side to determine that the need or the desire is there to do something like this. What about administrative forms? We try to make this easy. Out on our agent website, we have product toolkits set up for every product that you're contracted for with us. And in those toolkits, you'll find everything you need to sell and market our products. I'll show you some examples of what's out there in just a little bit. But one of the things that we have is our application and forms package. You'll answer a couple of quick questions, and it will automatically generate for you the forms that you need to do business. So make sure that you use the app package to get all the forms that you need, and you'll be in real good shape to get off to us what we need to underwrite the business. One of the things in the app package that will come out, by the way, are a set of instructions that take you through instructions of how to get the forms to us. And then also, more importantly, it'll take you through the instructions to complete the point of sale underwriting process. That's where as soon as you finish the app, you can pick up the phone, call our call center, and knock out about a 12-minute interview with your client where all the time, we're going to be able to give you an immediate underwriting decision. We'll talk about that point of sale underwriting in just a moment. In the product toolkit, there's many other things, agent guides, proposal software, client brochures, customizable marketing flyers, our mobile link instructions. I'll talk about some of this information later on. So now let's get into our single premium whole life product. Same concept. Client has single premium dollars, but there's a lot of similarities between single premium whole life and generation legacy. I'm going to point out to you what some of the key differences are. The first of which is the source of funds. This product is designed to take single premium dollars from after-tax cash vehicles, such as CDs, money markets, mutual funds, and where appropriate, 1035 life-to-life product exchanges. Still has the goal of increasing a client's estate, providing that estate value increase that they need to pass money along to family members and favorite charities. Issue ages, here's a key difference. The issue ages are a little bit wider, 50 to 85 instead of 50 to 80, because we are working with those after-tax cash funds. Another key difference is simplified underwriting tables available. Not only do we have standard through table 4, but we now have table 5 through table 8. So we go through 8 tables of underwriting for this product. We also have our accelerated death benefit rider, which still provides all those same three health event triggers we talked about, and it still provides all the living benefits your client's going to want. But this rider has a little bit more liquidity, a little bit more flexibility for the payouts, and I'll show you how that works. So again, issue age is 50 to 85. It's again based on current age or age at last birthday, non-tobacco and tobacco underwriting classes, and as I mentioned, 2 tiers of underwriting, standard through table 4 and table 5 through table 8. Minimum premium to get this started again is only $5,000. How many clients do you have out there that have multiple CDs in the bank that they've pretty much, siloed their money? I have these CDs set up for my kids, for my grandkids, all the money they want to pass on, they've siloed or put them in buckets. So why not be able to talk to a client like that and show them that they can pass along a much greater amount using this type of single premium concept? What about that client who you're working with, who you're trying to maybe sell a small face amount of life insurance to cover final expenses, and they say to you, I really don't need a life insurance policy. I have a burial account already set up. Well, that means one of 2 things to me. It either means a pre-arrangement at their local funeral home, or it means probably a $15,000 CD setting at the local bank that their kids know that's the money set aside to bury them. Well, I'd say to Mrs. Jones, who happens to be 70, Mrs. Jones, you're 70. You're going to live many more years, and I'm sure you agree costs are going to go up. What if I was able to show you a way to take that $15,000 CD and provides your family with nearly a $25,000 income tax-free death benefit. Oh, by the way, if you became terminal in a nursing home or an extended care situation, you could get at some of that cash to help with your end-of-life expenses or whatever expenses you may have, and we can set it up so that you still have some remaining life insurance for your family. That's called the burial account concept, and I can't tell you how many agents get started selling single premium products in this way. The maximum face amount that you see for the single premium product is based on what we call the net amount at risk, and that's simply the difference between the premium paid and the face amount that we issue. That difference or gap is the net amount at risk, and we have a table here that shows based on age and underwriting level what the maximum is that we will issue. Cash values, they accumulate in this product again on a non-participating basis, but here's another key difference: partial surrenders. Because you're working with after-tax cash funds, you can start taking partial surrenders on this product within limits starting in the second policy year. So in year 2, 10% is available for a partial surrender, 20% in year 3, 30% in year 4, 40% in year 5, and from the 6th year forward, 100% of the available cash value can be taken as a partial surrender. Loans, again, they're available at any time at a maximum rate of 8%. So the accelerated death benefit, same 3 health event triggers I gave you for Generation Legacy, same fact that it's going to be paid out once and it's going to be paid out in a lump sum to your client, and these are unrestricted funds. But with this product, the client has an option. They could say, you know what, I don't care about the life insurance on the back end. I want as much money as possible on the front end, and so I want to do a full acceleration. That's one option. Or they might say, well, I do care about the life insurance benefit, so let's take a certain amount of money now as a living benefit and keep a certain amount of life insurance. That's called a partial acceleration. I'll show you how that works. So here's some examples of how it works. We talked about terminal illness trigger, same definition, 12 months or less to live. But now if the client wants to do an acceleration, whether it's full or partial, the amount payable is 95% of the face amount, less the $250 admin charge. Now, people will ask me, well, what happened to the 5%? Well, any life insurance company who has this type of rider either has a lean approach or has this type of an approach. There's a certain amount of holdback, if you will, knowing that the client is going to die potentially then 12 months from this point. So, you know, if I'm paying out a death benefit early, it's a fact that you, in fact, have to hold a certain amount of that benefit back. So I skipped the slide here. So for terminal illness, they could do 95% full acceleration, and the product is done. You know, they've got their payout, less the admin charge. Or they could say, you know what, I have 100,000 face. Let's keep 25,000 of life insurance over here paid up and accelerate the other 75,000 at that 95% rate, less the $250 admin charge. That's called the partial acceleration. For nursing home confinement, again, the same definition to qualify as we have for Generation Legacy, but now because they're going to live longer, the maximum accelerated rate is 90%. And then for extended care, home health care, and adult daycare, it's the same definition to qualify because they're going to live longer, yet the maximum accelerated rate is 80% less the admin charge. Always remembering you can do a full acceleration, getting as much money out as possible at these rates and having no life insurance, or keep a certain amount of paid up life insurance and accelerate at these rates for a partial acceleration. Same definition for chronic illness, 2 out of 6 activities of daily living, or a client suffering from a severe organic mental illness. So now let's take a look at premiums to death benefits. And I want you to think about those clients you have out there who you know have CDs, money markets, mutual funds, maybe a failing UL where you know eventually it's going to collapse. Why not try to save some of that? So here's a 65-year-old with 50 grand. For the male, we would be issuing a face of nearly $82,000. And for the female, a face amount of nearly $93,000. Keep in mind, with this product, we have a level 2 of underwriting, tables 5 through table 8. And you'll always find with this product, at all ages and genders, the difference between level 1 and level 2 in terms of face amount is about $5,000 to $6,000 less, as you see here. So what did you just do for this female 65? You've increased with her leave behind money she had sitting in a CD with no plans of ever needing it, just wanted to pass it along. She increased her estate value by nearly $43,000. Now, if she were in a 25% tax bracket and getting 3% on the money, it would take her about 28 years just to accumulate that bumper increase you gave her an estate value of nearly $43,000. Always remember, life insurance benefit of nearly $93,000 is income tax free. Here's the 70-year-old, little older, shorter life expectancy, but the numbers still look pretty good, don't they? For that same $50,000 at 70, you're looking at a male getting a face amount of nearly $74,000, the female a face amount of just over $82,000. And again, at level 2 underwriting, the face amount reduction is about $5,000 to $6,000 less. So if a female 70 can put in $50,000 and see a $32,000+ increase in her estate, and that's all she's trying to do is pass the money along, that's going to really be received very, very well. Not only do you make that type of a sale, but hopefully you're asking for referrals early and often, because clients like to talk to their friends and their family members, and this is a great product to get referrals on. Same story I gave you on Generation Legacy. Go to the Baltimore Life Agent website, go to the product toolkit for single premium whole life, and go to our application and forms package for all your forms, instructions to do our point of sale underwriting, as well as all the great marketing pieces. So now I do want to talk about what I think is the icing on the cake for this product, and it is our point of sale underwriting process. And this is where, you know, we had a lot of annuity producers years ago when we started Generation Legacy who said, you know, I get the concept of asset transfer, but quite frankly, I don't like life insurance underwriting. It takes too long, and that's why I'm in the annuity market. So we were able to say, well, what if we can give you an immediate underwriting decision? And that's how point of sale underwriting came about. So you finish your app for either one of these products, you pick up the phone during call center hours, and you call with your client and complete a 12-minute interview where we're basically going to ask them the same health questions you completed on the paper app that you submit, but we're going to get their permission to get the data we need to look at in real time from the Medical Information Bureau and the Prescription Drug Database check. That way, if there's any conflicting data out there as compared to the app, we can do the real-time live underwriting and underwriting decisions. When the call is completed, any underwriting decision is not communicated to your client, it's communicated to you. You're the one that's going to be communicating to your client the underwriting decision. We will also give you a confirmation number that we ask you to write on the app for that phone call. Now, once the appointment's done, you must send us all the forms, no matter whether, you know, whatever the underwriting decision might be. Call center. Let's talk about the call center. These instructions, by the way, of reaching our call center and doing this interview are in the app package. They'll print out with your other forms. So the phone number is 888-368-9678. The hours are 9 a.m. to 10:30 p.m., Monday through Thursday, as well as 9 a.m. to 6 p.m. on Friday. These are Eastern times. Please know that we do support English and Spanish languages. Other languages are available upon request. And if you have a hearing impaired client, we have TTY services in both English and Spanish. Please know, though, this interview must be completed in 5 business days in order for us to complete the processing of your app. Now, you may say to yourself, well, I get it if I call during call center hours, but what if I'm writing this case on a Saturday or after hours? What do I do? You still want to pick up the phone after your appointment, and you want to call our call center and leave a voice message with your name and number, your client's name and number, and a date and time you want us to get this interview done. We'll call your client at that date and time, get the interview completed, and again, call you back with the underwriting decision. We don't give that to the client. You're the one that's going to communicate it. How do you pre-qualify a Generation Legacy app? Well, we have an app for each product, and the reason we do for Generation Legacy, it's 1 tier of underwriting, and single premium whole life, it's 2 tiers. So for Generation Legacy, you know, we have 1 section of medical questions, a Part A. Think of them as knockouts. If you get a yes in Part A, it means you don't qualify. If you get all no's, your height and weight and drug history look good, we're going to issue this thing under 4 tables of underwriting. For single premium whole life, we have 2 tiers of underwriting. So as a result, we have two sections to the app, Part A and Part B. Still think of your Part A questions as knockouts. If you get a yes in Part A, it means your client does not qualify for 8 tables of underwriting. But if they're all no in Part A and B, we're going to issue Tier 1, assuming everything else looks good. And if you get all no in Part A, but 1 yes in Part B, with everything else looking good, we'll issue Tier 2, which is Table 5 to Table 8. So with that, I'm going to transition real quick for our remaining time and talk a little bit of marketing with you here. So hang in with me. We talked about the Baltimore Life agent website and our product toolkit. So on this screen, you have a partial screenshot of the homepage of our agent site. These are all personalized sites with your production dashboard, and everything is personalized, including the product toolkit. So we're only going to show product toolkits for those products that you're contracted for with us. Inside the toolkit, and this is a screenshot of Generation Legacy, you'll see a series of links to all the tools that you're going to need to do business with us. This is one of the things that I talked about, and I'd like to talk about a little bit more here, and that's our Mobile Link software. Mobile Link is not a downloadable app from an app store. This is basically a website, mobile.baltlife.com. That's all you have to type in. And when you get there, you want to hit a shortcut on your connected device, your phone or smart tablet, and you want to create a shortcut to that device for this site. It'll create the shortcut for you, and now when you launch it, this is like having an interactive agent guide in the palm of your hand. It'll provide you with the product information, the underwriting guidelines, and more importantly, an interactive rate and value calculator. Remember that ledger I showed you before for Generation Legacy? You can actually show that through Mobile Link. So because these are non-illustrated products, you don't need a signed illustration. You technically can pull up everything you need right on your connected device. We have point-of-sale presentation softwares out there for you, which, I talked before, and I'm going to glide through these as I'm talking about them, that it's so important after doing an effective fact find that you conceptually have the client understand how the product works. What is asset transfer? What does that mean? Ask those key dialoguing questions. What are the features and benefits of the product? How does it really work? And this is where we use the conceptual idea of the gift box that I talked about before with you. We get into things like, show me the impact this can have on my estate value. Let's talk about the accelerated death benefit rider, and then try to move towards an application. And of course, probably move towards an illustration to verify their amounts of premium and the numbers that it will produce, and then on to an app. So the Generation Legacy point-of-sale presentation is out there for you, as well as we have one for single premium whole life. This is another great form. I'm sure hopefully you have a good fact-finding process, but if you need a little additional help with this type of market, we have our asset transfer analysis form, which will allow you to collect all the clients' current liquid assets that they have in CDs, money markets, mutual funds, annuities. And you can show them on this middle section that if they transfer a portion of the funds into the appropriate product, the impact that'll have on their estate value. The bottom of the form allows you to collect their current monthly income, so you make sure they have enough income coming in order to start moving money around that they're using. You don't want to pull money away from money they'll eventually need as income, of course. And the top of the form gives you those key dialoguing questions to ask. So it's a great tool to help you with your fact find, to determine if you have the need, pegged correctly, and know the correct amount of funds to move over and where the funds are coming from. Another form that's out on the Agent Product Toolkit is what we call our single premium sales idea document. On this screen now are just highlights of some of those ideas, but on each of these ideas, we have details of what we are talking about. And we get into detail about the idea. The great thing about the single premium sales idea document is that you'll start thinking about people that you can immediately call on or go out to see once you start reading these ideas. And many of these we've talked about here today. We've talked about the leave behind money concept. We've talked about people that have annuities in force, but if you simply ask, you're going to find out the large majority of them are never going to annuitize the funds. They're simply wanting to pass it along. Great prospects for Generation Legacy. What about the older paid-up life policies? It can be one, it could be 5 of them, where the cash values are close to equaling the death benefit. You can 1035 those into single premium whole life. The UL rescue concept, we talked about that. The burial account concept, I role-played that with you. The generation legacy spouse option, just a number of other ones out there. So take a look at that document. It's our single premium sales idea document found in the marketing section for both generation legacy and single premium whole life. We have these customizable marketing flyers that explain the concept of asset transfer, features and benefits of a solution, and then give you a fillable for your contact information. So you can personalize these, use them as mailers, leave behind pieces, an event flyer, whatever you might need it for. We have an Excel file calculator out there that can be used for single premium whole life. So, I can remember, I'm a licensed agent myself, where I had an old neighbor of mine who said, I'm setting up multiple CDs for my grandkids. I said, what are you doing that for? Well, I'm doing it to help them, have money for college when I pass or whatever the case might be. I said, well, what if I was able to show you a way to provide that benefit that you'd like to provide down the road right now through this type of a product? And, you can show side by side the impact of putting so much money into a CD versus into single premium whole life based on a certain interest rate and tax bracket, the impact that will make and the difference, that significant difference that you'll see by purchasing single premium whole life. We have white papers out there, third-party articles. All that information can be found on, again, our agent website inside the product toolkits. So before I wrap up here, Kathy, I just wanted to give one plug, and that is for our recently announced conference to Dublin. Wow, what a trip this is going to be in 2020, July 12th through the 16th. I hope you already have it on your calendar now to head over to Dublin, Ireland. It's going to be a fantastic conference. It's really, the qualification amounts are very easy, I think, to hit, especially with this product. You're looking at $75,000 of conference credits to qualify, which converts to $750,000 in premium. So take a look on our agent website for more information on the Dublin trip, and we hope we see you there with all of our leaders. On behalf of Baltimore Life, I want to thank you for participating today, and Kathy, thanks so much for the great partnership that we've had with Premier for all the years, and I'll give it back to you.
Thanks, Gary. You did a really great job, and I'm excited about this 2020 conference. That looks amazing. Just want to see if there's any questions out there. If you do, go ahead and type them up so we can get some answers for you. Otherwise, you're always able to call Premier at 1-800-365-8208. Extension 3008 will get your life team. Any questions that you have, we can help you and get contracting out to you right away if you're not already contracted. So, Gary, I think you did a very wonderful job. A lot of great information out there. I learned a couple new things too. So hopefully the agents are excited and ready to write some business with us.
Sounds good. Thanks, everyone. We really appreciate your business. Have a great week.
Thanks a lot. Take care. Have a great day. Bye.